Follow the yellow brick road. Follow the yellow brick road. We're off to see the lender. What's going on, guys? This is Min with What's a Mortgage. Today in our video, we're gonna go over the loan process, the 9-step loan process, and the do's and don'ts while in escrow. What's going on, guys? My name is Min with What's a Mortgage. Welcome to our channel. The goal of our channel is to educate, empower, and connect you with the right mortgage. If it's your first time tuning in, do us a favor, hit the notification or subscribe button so you're notified every time we go live or post a video. How's it going, guys? Also, if any of our information brings you any value, do us a favor, hit the like, hit the share button. So before we get into the video, I want to share something with you guys. I noticed that you guys are asking specific questions regarding credit. So I want to address credit. So credit plays a heavy factor in qualifying for home ownership. When you're buying a home, I do recommend that you run your credit with a lender, especially you worked hard, you saved your down payment, you paid down debt, but you don't know where you stand with your credit. You want to know, especially if you're going FHA or VA, you want to have a 660 credit score or higher because you're going to maximize the lowest interest rate and get the most closing cost money. So if credit in your stomach is an issue, don't wait till you find a home to run your credit. I always recommend you run it 90 to 120 days before that. Your credit report is good for 90 to 120 days. So I do recommend that you run your credit before you decide to jump in and find a house and fall in love, and all of a sudden you get a loan with the interest rate that's too high and you have a higher payment and you don't love the house, you don't love the payment anymore, so it's hard to love the house. All right, guys, so that's one little tidbit. So let's start with the loan process. So now you get excited, you've been pre-approved, you've been looking for homes, and you've been driving around neighborhoods seeing home after home. Finally, you write an offer, and that offer finally gets accepted. Then what? This is a video you want to share with somebody that you know is about to get their offer accepted. You want to share this video with someone who's out there shopping for a home right now. The last thing you want to do is get your offer accepted and not know the loan process. So loan process, I broke it down. It's like a game of hopscotch. The original triple OG hopscotch. So these are the 9 steps of the loan process. If you understand the loan process and you understand the hiccups in between, you can now compensate for that so you can minimize hiccups, minimize anxiety, minimize stress, and minimize delaying the escrow. So knowing this process is so important. So let's start with the process. Step number 1, your offer gets accepted. You and the seller have finally agreed to the purchase price, the close of escrow date. So after that, you need to cut a check, an EMD, an Earnest Money Deposit check to escrow, even if you're doing 100% financing. So a lot of people do ask that question for Cal HFA. Every state has their own down payment assistance program. Every home that you write an offer for, you do need an EMD check, even though you're getting 100% financing. Same thing for veterans. Even though it's 100% financing, you do need an EMD check. The EMD check, when it clears, takes the house off the market. That's when the realtor, a lot of times realtors, they're premature and they'll go on the MLS and say house is in escrow. What happens if the check bounce, right? A lot of things can happen. Let's say you agree to everything, but if that EMD check doesn't clear, we have no escrow. With no money, there's no chance escrow is opening. So now that the EMD check clears, one thing you want to pay attention to, if you're a buyer and you're about to cut the check before the check clears, these are the things you want to remember. You want to write this down. The loan contingency date, the appraisal contingency date, and the close of escrow contingency dates. You should have those 3 dates memorized. That's when you know to put heat on the appraiser and the home inspector, heat on the lender to have your approval and have the appraisal. You want enough time for the lender and for yourself to review the appraisal, review your approval to make sure it's conditions you can get before you release contingencies. If you release contingencies before this is done, you can lose your deposit. So make sure you pay attention to those 3 dates: the loan contingency, the appraisal contingency, or they call it the home inspection contingency. Everyone words it a little bit different. And last but not least, the close of escrow date. You want to make sure you know when you're going to close to make sure the lender is moving, to make sure everyone in the party is moving, to make sure you close on time. Last but not least, if you're a wage earner, in step 1, as soon as you cut that check before it clears, please notify your employer, I am buying a house. When you receive my verification employment, I need you to fill it out perfect. and need you to fill out the overtime and bonus. If they don't fill out the overtime and bonus, make sure they say it's company policy that they don't fill it out. But make sure that's done before they send that VOE out. If it's a work number, get that work number from your employer before the check clears so you can go ahead and have the processor order the VOE. Step number 2, the processor sends out your loan estimate. So after the check clears, they have within 3 business days to send out the loan estimate. The loan estimate, your disclosures, this is when the processor collects all your documents, your pay stubs, your tax returns, your credit report, where your down payment's coming from, the finalized purchase contract, the title report, escrow. You sign all that information. You're prepping everything to go in line for underwriting. You want to make sure you have the most updated pay stubs, the most updated bank statements. If you're using a 401k or an IRA or retirement, you have the most updated quarterly statement for them to underwrite, because you don't want to get conditioned for those. You will get conditioned for updated information, so why waste your time? You want to make sure you give the processor everything they need for them to review it. So once that happens, before it goes in line for underwriting, before you sign anything, you want to look at the loan estimate. When you're looking at the loan estimate, I want you to pay attention to, number 1, what is the interest rate on the loan? Number 2, on the top right corner of page 1, it will tell you if the loan is locked or not. You want to pay attention to that because you want to know where you stand with your interest rate. And next section, page 2. This is where the funny business happens. You want to pay attention to page 2, section A and B. That's where the lender can control the fees. Last but not least, section J, the lender credit. You want to reaffirm everything with your loan officer. Hey, this is my interest rate. These are the fees. Is this correct? Before you go ahead and sign the loan estimate, sign your disclosures, turn in anything, right? This is a moment where you want to know that this is what you're going to get in your loan. Also, you have time to shop it. You might only have a day or 2, but you want to verify these numbers first. So that's step 2. You gather everything, make sure everything is updated. Then the next step is step 3. Your loan approval. Congratulations, your loan is approved. There's 2 types of loan approvals. It's a conditional approval and a final approval. This is your conditional approval. So your conditional approval is where they'll ask you for new information, especially if you have old pay stubs that are over 30 days old bank statements that are over 60 days old, quarterly statements that are like 2 quarters back, whatever outdated information you have. If there's big cash deposits, you need a source. This is where the conditional approval comes out, and you go ahead and make sure you collect the condition. Good loan officers, good processors normally don't ask for updated conditions on the conditional approval if they get collected up front. You know, when I was a loan officer, I would collect updated pay stub, updated bank statements every month while I'm following up with the client until they get their offer accepted. I didn't want to wait till when my offer got accepted to go ahead and gather more things, just in case you did take time off, just in case overtime or bonus did decline, just in case you don't have enough money in your account. You want to address it for the initial approval, because if you get that done for initial approval, your conditions are going to be easy. Step 3, this is where it separates the men from the boys, is that approval. The easier the approval, that means that processor, that lender did a great job up front, and you did a great job by collecting all the documents for the qualification. So now step 4. Step 4 is when normally the appraisal's ordered. You can order your home inspection, your termite. You want to get all this done before the loan contingency and appraisal contingency. You want to get all this cleared, right? So that's why I want you to pay attention to the loan contingency, and I want you to pay attention to the appraisal home inspection contingency, right? So in step 4, all the conditions are ordered. If there's any verifications that aren't ordered, are ordered, okay? The quicker, when they give you a list, you get it back to the processor, the quicker your loan will move. For example, if you get it within 24 to 48 hours, you will be on pace to closing your loan. So you want to make sure you stop everything you do, gather your conditions. A lot of you guys have to go to work, scan it, and email it over. What I would do is I would ask for, hey, can you label the conditions in the order you want them? What I would do is I would provide the conditions, label it from the number they give you, and then email it over. You want it to be so seamless, right? I've seen approvals where the conditions are upside down, or you can't even see the bank account, or you can't see the pay stubs. The income's not broken down. These are the things that stall out fundings. You want to make sure you provide everything neatly and it's self-explanatory. And if there's any letter of explanation you need to fill out, make sure you write it correctly. Why you're upgrading, why you're downsizing, why you took time off. You want that information broken down and it's provable. So that's step 4. Step 5. The underwriter looks at everything. This is where we're going for the final approval. This is where the underwriter looks at all the documents to clear your loan to go to docs and provide you the final approval. This is when, if all the conditions clear, they send out the CD, the closing disclosure. Once the closing disclosure goes out, within 3 days, you should be going to docs. I don't recommend this, but some of you guys who want to know, when should I get my 30-day notice? When the CD goes out with most companies, not all, most companies, I think it's a good time to give your 30-day notice because you should be signing docs within 3 days after the CD goes out, right? But if the CD doesn't go out, that means there was conditions that weren't met, number 1. Number 2, the value of the appraisal came in short. Remember, when you order appraisal in step 4, in step 5, they verify it. So this is where the renegotiation happens. Number 1, you got to come in with a difference. If you got to come in with a difference and your assets don't prove that you have the money, you're going to have to get another bank statement from one of your other accounts, source it, season it, and see if you have enough. Number 2, you negotiate, you come in with half, and the seller backs off half. You might have to show another bank statement if you don't have enough money. Or number 3, the seller caves in because they don't want to go through this process again. They know if another buyer buys a house, the value is going to come in short, especially with FHA and VA. The appraisals are logged in. They can't really switch out the appraisal and get a new one. So if it's FHA, VA, a lot of times the seller will either ask you to come in with a difference or they'll drop the price because they know if another FHA or VA borrower comes through, they're gonna have to go with the same appraisal. So sometimes if they relist it, they'll say, I only want a conventional offer because you know that the FHA or VA appraisal did not appraise. So this is where the anxiety comes in because this is the unknown. Is it going to clear? Is it not going to clear? In your mind, you're like, oh my God, I turned in all my conditions. What's going on? The loan officer's not calling back. Oh my God, the value came in short. I don't have enough money. Step 5, I feel like it's the calm before the storm. So step 5 is what you really want to emphasize. Hey, are my conditions clearing? Am I missing anything else? Ride your loan officer and your processor until you get to step 5 clears, right? Because you want to get to step 6. Loan docs are out. You've signed your CD. It's been 3 days. The loan docs go out. So when the loan docs go out, you have 2 options. Number 1, a notary can come to your house or to your work and sign you. If there's more than multiple people, they can sign both of them. If they're both at work, some notaries will go to each person. Then it's 2 sets of docs you got to sign, 1 for each person. Or step 2, you can go sign at the escrow. If you go sign at escrow, the escrow fee is typically a lot cheaper. Also, if you have questions about fees, escrow people will probably be more accurate than using a random notary. Some people use their cousins as notaries, or they're using someone who's a notary. There's 2 types of notaries: notaries that notarize mortgage docs, and there's notaries that notarize everything. The guys that do everything sometimes don't specialize in mortgage docs. You want to understand the mortgage docs. You want to understand the loan docs. You want to understand everything, right? So step 7. So once the docs go out, you sign. You're going to sign 2 sets of docs. You're going to sign the loan docs and escrow docs. You're going to sign the note and the deed. Also, in the signing the loan docs, you're going to sign the final HUD, aka the final receipt. This is the receipt that will tell you exactly how much money to bring in for the rest of your down payment and the rest of your closing costs. So step 7 is once you read it, and if there's any problem, this is where you call your loan officer, your processor, or go over it with your escrow officer. Hey, this is off. The numbers typically are not off because the numbers are calculated by computer system. So if there is a mistake, it's a mistake in how they input it, not in the math, because all the math is calculated, right? Give you guys a tip. When you're signing your final HUD, or when you're signing your loan estimate, or you're signing your CD, page 2, section B, there's going to be the charge for the upfront mortgage insurance or the charge for the VA funding fee. And of course, as veterans, if you have 10% disability or more, guess what? There's no funding fee. You will see this huge charge. don't worry, it's not a lender charge, okay? There's a one-time in section B, page 2, section B, it's not a lender charge. It's your upfront mortgage insurance or your funding fee. Just know that if you look at your loan amount, it's higher than the minus, if you take the purchase price minus the down payment, why is the loan amount higher than just the down payment? They added in the upfront MI on FHA loans, on VA funding, right? On 100% financing. There's a reason why the loan amount is higher than the purchase price. It's the VA funding fee. But you'll see it show up. Just know that they increased the loan amount to cover it. So that's not a fee that you're short to close. Oh, I got to come with this. They're overcharging me. Just know that they're increasing your loan amount to wash that charge, okay? So now you signed everything. You have your final HUD. Step 8, you start marching down to the bank, down to the bank, down to the bank. You get the money and you wire it to escrow. You want to use the bank statement that you showed the lender. Do not pull a random bank statement out of thin air and start sending money from it. This is what causes escrows to either cancel, redo, or delay. You want to make sure you wire it from the account where the money is at, where it's been seasoned. If it's from a 401k or IRA, you wire it into a checking account or savings to wire it in. Wherever it is, if it's a gift from your donor, you want your donor to wire from their account over to escrow. You don't want to wire it into your account. Now you have to source it again. We want to minimize more and more paper trail. You want to shoot it right into escrow, right? So once you march in, you bring your money in, and you do your final walkthrough, guess what? Step number 9, congratulations, your loan has funded. So those are the 9 steps of the process of home ownership. So now you got your offer accepted. Now you know the 9 steps, what to expect in the loan process, right? Step 5, that's the one you want to focus on, right? That's the one that's going to pass through. That's when you're pretty much in the safety zone. So now that we know the loan process, the next thing is do's and don'ts while you're in escrow, right? Let's go with the do's. Stay consistent at your work. As you're in escrow, do not take time off. If you're working overtime or you're getting commission, make sure it stays consistent while you're in escrow. You don't want a recent paycheck to drop your income and have them recalculate it. You want to ask your loan officer, did you use my overtime or my bonus to qualify me? If they say yes, which happens most of the times, you want to make sure you stay consistent, right? Do's number 2, send your loan officer all the documents they need promptly. You want these conditions moving through. Don't prolong it. Don't send it in upside down. I wouldn't even stamp it with my phone, even though you can and it scans it. It's kind of, especially if it's small letters, go scan it from your work or go to I don't know if Kinko's are still around, or go to a FedEx or a UPS, you can scan it in. Number 3, save your money. Don't start spending till your house is closed. You know, some of you guys are out there buying furniture, buying paint, buying all these things. You want to save your money just in case you're short to close. Number 4 of the do's, pay your bills on time. Do not allow any late, especially if your credit report is close to that 120 days. The last thing you want is a credit pull or a soft pull, and they see there's late, which will drive down your credit score or delay your closing or fall out of escrow, right? One last do, give your loan officer more referrals. If they did a good job, more referrals. They did a bad job, no referrals. So you tell them, hey, I got my Aunt Susie, Cousin Becky, Uncle Tom, Uncle Johnny, Uncle Robert. They're all going to purchase a home, but you got to make sure you take care of me first, right? Let your loan officer know. Those are the do's. Let's talk about the don'ts, right? Don't you wish your girl, no, I'm kidding, right? The don'ts, right? Don't take time off of work. It's kind of like same thing as the first one, right? Don't take time off of work. Work your normal shifts, work overtime. People fail on this step so much because they're going to the house multiple times to check it out during work hours. They're bringing their family relatives by during work hours. Everything they do is during work hours. So a lot of times it messes with your income. Don't rerun your credit with a bunch of creditors. If you're buying a mortgage, if you're running another lender run your credit, that's fine. Don't run your credit for credit inquiries to borrow for electronics, for things for the house yet, right? Don't do that. It can bring down your credit score. Don't bring up your balances. Like I said, your credit report is good for 90 to 120 days. The last thing they want to see is a higher balance that can change your DTI. Some of you guys are barely qualifying. Make sure you don't run up any credit cards, right? Don't finance anything large. Don't finance your furniture yet. Don't finance your electronics, your jewelry, your refrigerator, your washer and dryer yet. Pump your brakes and drive slow, homie. Remember that song? It's old school, right? But pump your brakes. And last, don't transfer money. I do this too. Let's say your account's like 110 bucks. You're like, man, let me put another 70 bucks, 90 bucks in it to make it even 200, right? Don't do that. Leave everything alone until you close escrow. I know we all have that itch. Don't scratch that itch, because now you're sourcing savings and checking. Oh, where's this money wiring back and forth? Make sure you don't do random transfers, okay? So that is the do's and don'ts while you're in escrow. Now that you know the loan process and the do's and don'ts when you're not in process, here's one last bonus tip. When you get pre-approved, right? There's two types of approval. There's a pre-approval and an underwritten approval, right? So there's a difference between a pre-approval and an underwritten approval. A pre-approval is scrubbed by the loan officer. The loan officer checks the credit report, we run DU, and then you get that in a couple hours, right? That is a very optimistic approval. The loan officer, don't forget, is a salesperson. If you're okay with the pre-approval, right, make sure, hey, just use my base income to qualify. It's really hard to mess up qualifying on base income, but if you're using overtime bonus, or you have 2 jobs, seasonal job, a full-time job, and a part-time job, or you just change positions, most likely you want to be conservative, right? If you do have very peculiar income, you want to make sure you get an underwritten approval. So not all lenders, but a lot of lenders now are doing these underwritten approvals, right? They're as good as cash. So a lot of times you'll see the pre-approval, and then the lender will start working on the underwritten approval. They'll start asking you for conditions. Don't be alarmed, like, oh my gosh, why are you asking me for so many conditions? Remember, they're getting the underwritten approval done. So when you find the house, guess what? Your loan is done. So ask your lender, hey, do you do underwritten approvals, or do you just do pre-approvals? Especially if you don't have peculiar income, you want that underwritten approval to make sure that you minimize your risk of falling out of escrow. So that's the difference between a pre-approval and an underwritten approval. Make sure you ask your lender, what type of approval will you be sending me? Guys, thank you guys so much for watching. I really appreciate all the comments, all the thank yous, right? If you're not following me on Instagram, please go to our Instagram and go to look up What's a Mortgage. And of course, we want to end all our videos with our attitude is gratitude. So thank you for everyone who watches, shares, likes. Thank you for everyone who watches on Instagram Live, on our Wham Fam group page on Facebook, and thank you for all the subscribers on YouTube. Guys, have a great night.